So in this video, I'm going to show you how to use FINRA's Morningstar information to find the bond information about your company. So it's going to be a little bit different and a little bit more complicated than it was using Bloomberg. Because all the information isn't in just one clear space, you're going to have to examine some of the bonds individually to find that information. But I'm going to go over this assignment. I still have you doing the same basic assignment I would have had you do using Bloomberg. So to find your company's bonds, you're going to go to this website, and this is FINRA, which is a website that has a whole bunch of information for you, and you can look on there. It's about advocacy for investors. So we can scroll down. This brings us to our bond page, and it automatically shows you how the market is doing as a whole, what's going on with treasury bonds. You can find that information on a lot of different things. But this one has the advantage that you can go to the search function and type in an issuer and look up that information. So I'm going to do Macy's because I know no one's using Macy's, and I just type that name in there and click Show Results. And this is going to bring up all of Macy's corporate bonds. So this is going to help me to answer the questions that I'm being asked. So the first question on here, how many issues does your corporation have outstanding? So that means how many bonds do you have right now? Now, when I'm looking this up on Bloomberg, it comes right up with a number. Here, I just have to count. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so my company has 10 bonds outstanding. Then, what does it ask me? It asks me to examine information about these bonds, all right? So, if your bond has multiple, if your firm has multiple bond issues outstanding, which in this case my company does, I suggest a summary chart to answer the following questions. So I give you a sample of a summary chart down at the bottom. And when I spelled maturity wrong, I'll have to fix that. All right, so what am I looking for? I'm trying to examine some of the relationships that I see about the bonds that my company has issued. So what are the bonds' coupon rates and maturities? Are they callable? And if so, at what price? When were they issued? And what relationships do I observe? Are they selling at a premium or a discount? Okay, so I'm going to go over here and I'm going to look at them. Yeah, it looks like 9 out of the 10 bonds are going to be callable. Only one of them is not. They're all regular corporate bonds. I have all of their different coupon rates, their maturities, their ratings, and then their prices. So when I look on here, all of my bonds are selling at a discount. I know that because all of their prices are less than 100. They're going to be quoted as a percent of par. So 100 would mean selling at a par value of 1,000. So all of my bonds in this example for Macy's are selling at a discount. I have all their coupon rates listed here. So you can click just like you do on Bloomberg, and it will sort them highest to lowest. So my lowest coupon is 2.875%. My highest coupon is 7%. All of them are triple B minus rating, which is Baa3 in terms of Moody's. Longest and shortest maturities, you can also click to sort them that way. So shortest maturity is January 15th of next year, 2021. Longest maturity, February 15th of 2043. Now, when I ask you to present this information in the summary chart, you can go down here and see highest coupon and lowest coupon, longest maturity and shortest maturity. You can have that automatically, just sort the way I did that. So include the coupon rate, the price, the maturity. Now, the issue date, you can also put callable. They're all callable. The issue date and the call price. Here's what's different about using Bloomberg versus using any other website. In order to figure out the issue date or the call price, with Bloomberg, it just tells me that information. If I'm going to do it using any other set of data, I need to actually click on the bonds themselves to see that information. So I'm going to go ahead and look at this individual bond right here. Okay, it's going to load it. So this is Macy's coupon bond with a coupon of 2.875%. It's currently selling at 75.21, so that's actually $732.10. This is a regular corporate bond. So It pays interest semi-annually. And if I want to see the call price, it is callable starting in 2 years in 2020, and its call price is 100. So that means it's callable at par. So I have to look in here to find that information. Original issue date, I have issue description, offer date. So the offer date is found right up here. 11/14/2012, and then dated date. So this is when it was originally offered. This is when it was, so this is the information that I want posted in there, the offer date. And then down here, that call price. So this is continuously callable beginning next year, and it's callable at par. Well, because people are buying these bonds at a discount, callable at par would mean that, the company already has to pay over for that. So what are the questions that I ask you to answer? I'm asking you to find relationships between announcement date, coupon rates, and maturities. What do I mean there? Well, most of the time when a bond is issued, it's issued at or really close to par. So what you will see is during times of high interest rates, the coupon rates are going to be higher. So if a bond was issued, say, in the 1970s, coupon rates or interest rates are incredibly high, so coupon rates would be high. If a bond is going to be issued now at historically low interest rates, then the coupon rate would be really low. So I'm looking for that kind of thing, and then understanding that relationship. So if it has a higher coupon rate, remember the coupon rate on the bond is fixed, even though interest rates in the market fluctuate. So the higher the coupon rate on the bond, the more likely that the bond is selling at a premium. When would I recommend recalling a bond? Well, if a bond is selling at a huge premium, it's because the company is paying out more than it should based on current market conditions, or more than it should based on that same amount of risk, or companies of similar risk if they were to issue their new bonds now. So a company would consider recalling if they had a bond that was selling at a super high premium. In fact, if the bond's price is above that call price, then it would definitely make sense for them to go ahead and recall the bonds. So that's the kind of answer I'm looking for there.